Good afternoon. My name is Carol Westropp and I'm Head of Legal Policy at the SRA. I'm joined today by my colleague Sean Hankin, who's a qualified accountant and has significant expertise and knowledge of the solicitors' accounts rules. This is the first webinar we are hosting on the third phase of our review of the accounts rules. You're probably aware that we launched our consultation on the accounts rules review in June. The consultation is open until the 21st of September, and we would like to take this opportunity to encourage as many of you as possible to respond to the consultation. We will talk to you for about 40 minutes about our accounts rules consultation, and while we're talking, you can submit questions, and at the end, we will have a short Q&A session where Sean and I will answer as many questions as possible. We are also in the course of compiling some responses to other FAQs we've been asked during our engagement over the last few months, which we intend to publish on our website very shortly. So we'll try to ensure that all of your questions are addressed if we don't have time to get to them today. You should also see on your screens a live tech support button. So if any of you are having any difficulties with the technology around this webinar, then please hit that button and someone from our technology support department will be there to help you. So the purpose of our webinar is to inform you about our accounts rules, to get your thoughts and views on our proposals, and to help us identify issues that we think need to be considered further. But firstly, I want to explain briefly how the changes to our accounts rules fit in and support our wider package of reforms. So we want to reform our regulation to help uphold standards and professional values, enable growth and innovation in legal services, while striking the right balance between reducing burdens and ensuring consumer protection. The changes to the accounts rules are an important part of our review of our entire handbook, and we're doing this as part of our regulatory reform programme to help give firms more flexibility in the way they deliver legal services, but whilst ensuring the right degree of consumer protection. This is particularly relevant when talking about how firms deal with client money. The legal services market and the way people choose and buy legal services is changing faster than it has ever done before, and we are seeing some significant changes in the way that legal services are delivered. For example, legal services are increasingly provided online. We're seeing much more legal process outsourcing and more unbundling of legal services, where the legal services provider undertakes part of the work and the consumers does the rest themselves. These changes provide both opportunities and challenges for firms. I refer on the slide to unmet need. So, for example, we know that 83% of small businesses with a legal problem don't obtain professional help from lawyers. And when they do seek advice, it's more often than not from accountants, more often than lawyers. So, looking to the future, what are we doing? Well, we've drafted and are currently consulting on a new code for individual solicitors and for firms. We're also currently consulting on the accounts rules. And looking to the future, our second phase of work will cover the rest of the handbook, such as our authorization rules and our disciplinary rules. And we are planning on consulting on these next year.
So turning specifically now to the accounts rules, what have we done to date? We have adopted a three-phase approach to the reform, and I will recap briefly on what we have done so far following previous consultations on these issues. Phase 1 was completed in October 2014 when we removed the requirement for firms to obtain an accountant's report where 100% of their client money was received from legal aid agency work. We also removed the requirement to file unqualified reports with the SRA. Phase 2 became effective for firms with year ends on or after 1st of November 2015. It removed the requirement to obtain an accountant's report for firms which hold only small volumes of client money. We also removed the previous very detailed prescriptive steps that reporting accountants had to follow when assessing compliance with the rules. We now rely more on their professional judgment about risks to client money. These measures together begin to remove unnecessary regulatory burdens on firms and help us move to a more proportionate approach to keeping client money safe. Firms with an average client account balance of no more than £10,000 and a maximum client account balance of no more than £250,000 no longer need to obtain an accountant's report. There is detailed guidance with worked examples on the SRA website about how the exemption calculations are made. The requirement to obtain a cease-to-hold report still remains. We believe the Phase 2 changes will bring a greater focus on the key risks to client money and the culture of strong internal systems and control procedures. The SRA website contains detailed guidance on key areas for the reporting accountant. This guidance will also be of assistance to compliance officers. There are certain key areas, though, where there have not been changes. Most notably, it's still the obligation for firms and not reporting accountants to submit qualified accountants' reports to the SRA. Those reports are still required within 6 months of the period end. And finally, the whistleblowing obligations of the reporting accountant still apply.
So now turning to the Phase 3 of the Accounts Rules and what we're currently consulting on in more detail. This third phase builds on the previous work we have done and which many of you have contributed through responses to our consultations and other engagement. So we're focusing on simplifying the existing rules, removing unnecessary detail and prescription. The rules themselves have not been thoroughly reviewed for nearly 20 years and were out of date in many respects. For example, they do not cater for the widespread use of internet banking, and in some cases impose a disproportionate burden on those we regulate. We also wanted to facilitate alternative arrangements for the holding of client money. As mentioned, our objectives are to reduce prescriptive regulation and focus on what is really important and what the accounts rules are really about, which is keeping client money safe. So to summarise, the consultation can be divided into 3 main proposals or strands of work. The first is around simplification of the rules, focusing on key principles for keeping client money safe, such as keeping client money separate from the firm's own money, ensuring its prompt return to clients, and ensuring that it's only used for its intended purpose. We're also proposing to change the definition of client money to allow money paid in advance for all fees and for disbursements for which the client is liable, for example, council's fees, to be treated as the firm's money, and as such it will no longer be held in client accounts, but instead in the firm's own business accounts. And thirdly, we're proposing on introducing alternatives to having a client account by introducing clear and consistent safeguards around the use of third-party managed accounts, or TPMAs for short, as a mechanism for managing payments and transactions. So we're going to turn to our first poll question. We've got 3 questions throughout the course of our presentation on which we thought we would seek some immediate views from you. So the first question is, do you agree, for those of you that have either read the consultation or have listened to what we've said so far, that our proposals strike the right balance between consumer protection and increased flexibility for firms? And it's a question of simply yes or no.
can vote now, about 30 seconds to vote. We hope you'll all say yes.
So the results are in. I'll just give it a few more minutes to refresh, or a few more seconds indeed, to refresh the answers that have come in. I should say that we think there's about 450 to 500 of you online. So of those of you that have voted, I'm pleased to say that about 93% of you have said yes, and about 3% of you have said no. So that is, I think, an encouraging statistic for us to work with. Appreciate, as I mentioned there, that many of you may not have had the opportunity yet to read the detail of the draft rules and the detail in the consultation. But as I've said, this is the balance we're striving to achieve through the consultation and our reform. So it will be interesting to see in detail some of your comments on our proposals.
Excellent. Thank you for those who voted there. There's two more questions to come up a bit later on. So the idea behind simplifying the accounts rules is to reduce the number of prescriptive rules and focus on setting out key requirements for keeping client money safe. We think this makes the rules clearer for firms, their employees, for new entrants, and also for clients. The proposed rules are considerably shorter than the previous rules, and we think are easier to navigate around and therefore more accessible. We have retained many of the key provisions, such as ensuring client money is kept separate, used only for its intended purpose, and returned promptly at the end of the matter. In the proposed rules, you may have noticed that we have made changes to the very detailed existing provisions in Rule 29 relating to client account systems and controls, as set out in our new proposed Rule 8. We are keen to hear your thoughts on this. Do we have the right levels of systems and requirements? Is there an appropriate level of control? So please do feedback through the consultation about those key issues. There are three main reasons why we are proposing to change the definition of client money. As was mentioned earlier, there is a public perception that there is a lack of transparency regarding the cost and pricing for legal services. The current position has evolved over time, and the rationale for some of the distinction as to how firms should treat, for example, money paid in advance for professional disbursements, which has to be paid into client account, and for other disbursements which do not, is illogical. At present, fixed fees are not client money, but money generally on account of fees in advance are. We think this reflects the fact that the accounts rules in their current form are old and have not been reviewed as a whole in a long time. We also think that the rules create some strange incentives about taking payment in advance in a way that does not tend to happen in other business sectors. Consumer protection legislation today is stronger than it was when the rules were originally drafted. For example, if you pay by credit card, you can take advantage of the protections under Section 75 of the Consumer Credit Act. Some debit card providers also offer similar protections. So if the services you've paid for are never received, you can make a claim through your card provider. So how will this be done? We are proposing a simpler definition based around liability for payments. With regards to disbursements that the solicitor is liable for, we do not consider that there is a continuing need to maintain the present position, that unpaid professional disbursements must be held in client accounts. If the liability for payment rests with the solicitor, the risks are less about ensuring that money is kept separate and more around ensuring that there are systems and processes to deal effectively and promptly with payments. We think the new definition provides a better balance between consumer protection and regulatory burden. We consider that the wider developments in consumer protection means that we can safely reduce the currently high levels of consumer protection in the accounts rules for fees paid in advance. However, as we anticipated, this aspect of the consultation is generating a range of views, and we are keen to hear what people think. So again, through the consultation, do you agree with the assessment that we have of what the possible benefits are of such an approach and the burdens for both firms and for clients? So now to our second poll question, which is, if we change the definition of client money, will you still need a client account for your business? So again, it's a yes or no question, and we'll wait to hear your responses. We would hope that the new definition will mean more firms have taken out the need to have an accountant's report each year, and hopefully therefore reduce the cost of the business and the regulatory burden that firms have. So I think with the results coming through now, so yes, we've got 8% of firms think they may now fall outside of a need to hold a client account with the new definition of client money, whereas 92% would still need a client account. So I think, although that's not, that's probably about what we expected. So we are taking more firms out of the need to have an accountant's report potentially, and the need to maintain a client account. So it's a move in the right direction anyway, hopefully.
So the third strand is in relation to the use of third-party managed accounts. So we're also proposing, as part of this consultation, that firms are given the option to use third-party managed accounts. And to be clear, because this issue has arisen previously, this is to be an option available to firms, and in no way are we proposing that this will be a mandatory requirement. So our objective for allowing third-party managed accounts is again to provide more flexibility for firms to meet their obligations to safeguard client money and assets, but also to balance that objective with appropriate levels of consumer protection. Third-party managed accounts would provide firms with an alternative to holding client money, but they may not be suitable or beneficial for all types of firms, transactions or work. However, having the option to choose a third-party managed account should, we believe, increase flexibility in the market and consumer choice. In order to ensure that appropriate consumer safeguards are in place, it is our suggestion, as you will see in the detailed rules, that third-party managed account providers must be regulated by the Financial Conduct Authority under the Payments Services Regulations 2009. We see no reasons to place any additional requirements relating to the providers of third-party managed account services as they are FCA regulated. Now, there has been limited development of this type of product so far, which we're well aware of, and the success of the market and the alternatives will largely depend on providers developing a product that is attractive to both firms and to their clients. But we do think that allowing flexibility through our rules will encourage the development of such products, and that this level of choice can be a good thing for firms and their clients. So what other key changes have we covered in the rules? Well, we've removed the prescriptive timelines. Rather than stipulating that monies must be transferred between office and client account within 1 to 2 days, and also removing the 14-day rule, we've referred instead to a more general term around moving money promptly, especially relevant to mixed payments. We've retained the clear duties to correct breaches, in particular to remedy immediately any shortage on client accounts, as that's obviously a very important consumer protection. Policy on the payment of interest has been moved to the provisions in the new draft Code of Conduct of Solicitors as a standard 8.8, and it's probably worth reminding you that it's worth looking at the draft code, which is also quite short and clear when looking at the changes to the accounts rules we're proposing, as both should be read to a degree in conjunction with each other. We've retained the current requirement on firms to obtain bank statements and do reconciliations at least every 5 weeks. That, of course, is intended to be a regulatory minimum, and many firms will want to do much more frequent reconciliations if required. And we've retained and redrafted the current prohibition in Rule 14.5 of the Accounts Rules on the use of client account as a banking facility, and that's been formulated as a new Rule 3.3, and again, we will be very interested in receiving your feedback on the way that rule has been drafted. We have also removed detailed references to those taking appointments, such as Court of Protection deputies and insolvency appointments. The accounts rules still apply where necessary, but we did not think it was necessary to have detailed provisions anymore in relation to those specific types of appointments. And we've also removed the detailed specific rules about payments from the legal aid agencies. We've been in discussions with the legal aid agency about the impact of that, and are fairly confident that with the change to the definition of client money, that it's appropriate for us to do so. We've replaced the specific waiver provision about accounts and reports, and we'll rely on a more general waiver provision in the future to allow us to provide greater flexibility in the rules when they might not apply. And we have a broader duty on firms to retain and store accounting records, with a new definition to be included in the glossary of what is an accounting record. So what do we hope this will mean for firms? Well, we hope, as we say, that it will mean a simpler regime, shorter and clearer rules, which are easier to comply with, more flexibility, because there's less prescription about how to run the detailed accounting process, alternatives for those who want to operate a client account and those who might wish to take advantage of third-party managed accounts, and as Sean referred to, perhaps taking some firms out of the need to obtain the accountant's report, for example, if they only hold either very small amounts of client money or don't hold client money at all, and leading to freedom to innovate and compete in the market. So turning now to our third poll question on the use of third-party managed accounts, we would be interested to know whether any of you who are listening and your firms might consider using a third-party managed accounts for your business. So again, we'd be grateful if you would take the time to answer our poll question and vote now. So that's interesting, the results of it. I'm just going to refresh them because we've got about 170 of you having voted so far. And of those who voted, about 20% of you would consider using a third-party managed account, and about 75% of you, sorry, 80%, forgive my math, wouldn't consider it at this stage. Again, this probably reflects the lack of maturity in the third-party managed account market and the lack of products. But it's interesting that there is a degree of interest in this as an alternative if the market develops to such a degree that it becomes a viable opportunity.
So what about reporting accountants? Well, In view of our recent review of this area, we are not proposing any more policy changes, but in line with our general approach, we have simplified the rules to remove what we consider to be unnecessary detail in the new rules. We will be providing a toolkit to provide a range of resources for firms to help them understand our regulatory requirements. We appreciate that some firms prefer a more detailed approach, but by changing the rules, we are hoping to provide greater clarity and a more proportionate approach. To give you one example of how changing the rules could benefit firms, recently we spoke to a solicitor who was practicing in a very rural area. Due to the prescriptive nature of the current accounts rules and the need to bank checks within a day of receipt, she had to take an hour of otherwise billable working time every other day to go to the bank to ensure compliance with the rules. Under the proposed new rules, a solicitor must bank client money promptly. The intention behind this is that money should be paid in within a reasonable amount of time, but this will depend on the circumstances in each individual case. If there is no risk in client money being deposited in client account until a few days later, the new rules will permit the solicitor to go to the bank less often and thereby free up more time for billable work. The toolkit we produce will not form part of the SRA handbook, and there is no intention for us to move existing rules into guidance, but rather move towards a more principles-based regulation. Our two consultations on principles, codes and accounts rules closed on 21st of September 2016. Further consultations on other rules and regulations, including new authorization and practicing rules, the enforcement strategy and disciplinary procedures, will be early next year. Implementation for these new accounts rules will be no earlier than 2018. We would welcome your views through the consultation process. And our next slide will give the links. We can't, if you're accessing the webinar live, you can't click these links now, but there is a resources tab within the webinar which will allow you to do so. And these links, when the webinar is downloaded and available on demand, will be able to access through the screen.
And I will just add there, Sean, that I think sometimes it can look a little over-facing to complete a detailed consultation response with the questions that we've raised. The consultation raised a number of questions where we're particularly interested in receiving your views. But if anything that we've said or we've read, actually you've got a specific point that you would like to feedback on, then an email back to us with that point is great. So whatever really suits you in terms of responding, we would very much appreciate your views. So we've got to the end of our presentation, and we have some time now in which to answer the questions that you have submitted. So we'll start with a question that has been answered and which I will ask Sean. I'm worried about the change in the definition of client money and the impact on my current software. So Sean, in terms of the impact upon the client money change and a firm's requirement to have accounting software, what's our position?
Okay, well, it is likely that there might be some changes required to firms' accounting software. We are speaking with various software providers at the moment to see what they might be. We're trying to keep any changes required to a minimum. I think from a practical point of view, it's likely that most accounting systems will be able to deal largely with the changes that we are proposing. However, we have flagged this issue and it's part of our impact assessment. And again, we are keen to hear your views as to how it might impact you on a practical basis in running your firms, or if you're a cashier or an accountant within a firm. We're also aware that changing the definition of client money will have an impact on how VAT is charged, and I'm seeing some questions come through already about this, and we may get around to a few of those a bit later on.
So a question's been raised, which is a good question, and one that is to a degree covered in the consultation document, which is, will firms still be able to treat payments on account as client money if they choose to do so? And that's covered, I think, in paragraphs 36 and 38 of the consultation document. And this issue about flexibility is a very good one. At the moment, we have drafted the rules to provide that money paid on account of costs isn't client money and therefore should not be paid into client account. But as the consultation covers and I think recognises, there may be elements where clients may require this or firms may like to offer that opportunity. So at the moment the answer to it is no, because we consider that having a degree of clarity between what is or isn't client money would be of assistance to firms and to us in relation to the exercise of our regulatory powers. But we would be very interested in views on this question and flexibility, and I think we have a question specifically on it in the consultation document. So it's a very good question, and one again that we would very much welcome views on.
Okay, so I've got a question here which says, will everyone be exempt from needing an accountant's report if we do not have a client account? Well, the answer to that is yes. If you haven't got a client account, you won't need to have an accountant's report. Hopefully that will reduce the cost of regulation and save money, which can be passed on to clients and help increase competition.
We've got another question here. It's about when will the new changes to disbursements being held into office accounts come into force? As I think Sean covered, obviously we're going through the consultation period. We set out our proposals. Obviously we want to seek views on those proposals. We will respond to the views that we get in our consultation response. And if we decide to take forward the proposals in their current view, then as I think Sean indicated, we're looking to implementation no earlier than 2018. We obviously want to make sure that the new rules are made in an appropriate form, that they're approved through our governance arrangements, and that firms have sufficient time to make sure that you understand and get ready for the implementation of the rules and its impact on your system. So obviously they're not in force yet. If it goes through as we have suggested, then we're looking at an implementation date of around 2018.
I've got another question for you actually, Carol. So who do the rules apply to? If I'm a solicitor working in a non-regulated, non-SRA regulated entity, would these new accounts rules still apply to me?
Yes, it's a good question again. The accounts rules as drafted make it clear that they apply only to firms that we regulate, although we have cast the net quite widely in relation to who they bite on within those firms because of the importance of ensuring that client money is handled properly. So the rules will apply to the firms, the managers and all of the employees as currently, but they won't apply to anyone holding client money outside of an authorised firm. And in fact, our Code of Conduct for Solicitors makes it clear that if you're a solicitor working for a body that we don't authorise, you can't personally hold client money. And that's because we have no regulatory reach over those entities and because the suite of consumer protections that go with holding client money and compliance with the accounts rules, access to our compensation fund, requirements for professional indemnity insurance, all come as a kind of package. So the answer is the accounts rules, in short, apply to everyone we regulate. I should say that solicitors who don't work in an authorised firm will still have an overarching obligation to keep client money and assets safe as part of their obligations if they are practising, as we suggest, in an authorised firm. but the accounts rules themselves apply to authorised firms holding client money.
Okay, good. So I've got picked out a question here about third-party managed accounts, and it says here, the question is, will there still be a requirement for instant access on those accounts? It will depend on the individual scheme. We're working with third-party managed account providers and checking that the schemes are fit for purpose and will do what they need to do. So it will be scheme dependent, but I'm pretty sure that instant access or as good as will be one of the requirements for those accounts. Otherwise, we're just building in delay or problems for clients with a new process.
So a question from David, when will the toolkit be made available? So this question has arisen in the engagement we've done previously, and I can understand why, in terms of the rules and the detail from the rules having been removed, there is perhaps a desire to see what the toolkit and the guidance and the supporting documentation that will help you comply with the rules might look like. So you will see in the consultation that we've set out 2 case studies which we've used to exemplify how we might position in the future the help that we will give. And we set out, I think, 10 or 11 separate areas of guidance where we are suggesting that we will provide questions and answers, decision trees, case studies, perhaps traditional, more SRA style guidance in terms of an advice note. But we will be very interested again in your views on whether those areas of guidance look right to you, how we can best support you in terms of providing the guidance, so whether an interactive toolkit, obviously you have and you will continue to have access to our ethics helpline. But we would be very interested in views on that, and whether, for example, in terms of our engagement with you, it would be helpful for us to draft 2 or 3 pieces of the guidance and put that on our website as part of our response to the consultation, so you can see how we think the toolkit will shape up. It's something we very much got in mind that we want to develop and develop in collaboration with those we regulate. Okay,
next question is, do these changes not put extra pressure on the COFA and the COLP? Again, a good question, because obviously these rules are a lot shorter, they're a lot less prescriptive, there's a lot less detail, so there's a lot more scope for interpretation. But we would hope that the changes we've brought in since the introduction of compliance officers has meant firms have a far better compliance culture, far stronger controls, internal controls, and also the changes we have made with the reporting accountants requirements mean that their tests can be far more targeted and supply more relevant suggestions for improvement in internal controls, that it will not increase greatly the burden on the COFA and the COLP or put extra pressure on those. We hope that systems that have been developed so far will just continue to assist and get stronger over time.
We've got an observation from a firm saying that they're a major conveyancing practice and they need client account for completion monies and stamp duty, as often completions take place on the same day as exchange. I suspect this is a reference to the third-party managed accounts. And just to reiterate that that's absolutely fine. There will be some firms for which a third-party managed account isn't appropriate and won't be appropriate. So for that firm, for example, at the moment, there isn't a product that probably could deal with bulk volume conveyancing transactions. Whether or not such a product might be developed in the future, then we shall see. But I think the intention behind the rules is to provide a framework where this can happen. Another question, which I'll touch on, because I think again a very good question, is are these changes going to be set in stone, or could there be further changes moving forward? when drafting the rules and looking at our sort of policy position, we have tried to make sure that the rules are future-proofed insofar as we possibly can, so that rather than previously where we've had to make changes, for example, to do with new ways of banking and so on, that they are drafted in such a way that there's flexibility, that the rules themselves won't need to be changed, and that we can provide assistance as technology, as it inevitably will, develops through guidance and other products. Of course, we can't foresee necessarily what legislative change might come our way and how we might have to react to other issues outside of our remit. But the proposals generally have been drafted so that they will be future-proofed and won't have to change regularly. And in terms of being set in stone, obviously, coming back to the same point, this is what the consultation is about in seeking views on our proposals at this stage.
Okay, I've got a question here which says, if I carry on with the existing rules, will I be in breach of the new rules? I find the existing rules very sensible and simple. Well, I think people have become accustomed to the rules over time. I think if someone came to look at the rules who wasn't within the profession or wasn't familiar with them, then they might find them quite difficult to understand. There's lots of rules, there's lots of referencing between rules, there's lots of different timelines and deadlines, but we also appreciate that people do like that prescriptive nature to them. The first part of the question was about would you be in breach in the new rules? Well, potentially yes, because the definition of client money has changed. So if you carry on with the old rules, you could be banking money into client account which wasn't client money. So there would need to be a change of processes and systems to take account of the new rules. But as Carol mentioned earlier, we do want to look through the consultation process at the issue of flexibility within the rules and how we potentially accommodate client instructions and what have you.
Just picking up two questions, perhaps from opposing sides of the debate. I've got one question. Is there any possibility that we may be able to hold money on account of fees as office money before 2018, as this would be a huge improvement? And an observation from one contributor that concerned about client monies being put into office accounts as firms will have greater challenges, and I suppose that's around the consumer protection. And I think that perhaps sort of exemplifies the way we've been juggling with these two issues of consumer protection and flexibility. The consultation document makes it clear that the proposed definition to client money will involve a reduction potentially in consumer protection, and we've positioned that with there are benefits and there are some risks. And again, as we covered in the presentation, we know this is going to be of perhaps the main interest to those of you that have to operate the system. And again, the range of views about the burdens and the benefits, the consumer detriment and the benefits to your firm from the change, please do email us directly with your thoughts on that. That would be most helpful. Okay,
I've got a question here about withdrawals from client bank accounts. So under what circumstances may client money be withdrawn from client account in the new rules? So again, the core purpose of the rules, even though they are a lot shorter, is to still protect client money and make sure it's kept safe. We've removed some of the detailed list of circumstances where client money can be withdrawn from client account, but we have maintained the key principles for when such withdrawals can be made. So, for example, they should only be made when for the purpose for which it's being held, and once you've, another example, once you've received instructions from the client or the third party. It could also be withdrawn when you have written approval from the SRA, for instance, when the client can no longer be located.
I've got a question from Keith. Thank you, Keith. asking how you, I suppose the firm, would account for monies taken via credit card payment that have to be split between office and client monies. Our provider only allows receipts to be paid into one account, i.e. client. So this is quite a new issue for me, and not one that I've heard of before, that there may be limitations by the payment provider in relation to payments. It's sort of slightly answered by the treatment of mixed payments. So obviously mixed payments, by which I mean money, for example, for a firm's fees, as money for stamp duty or money for a house purchase might be received by a firm. At the moment, most of you will know that there are quite complex rules about mixed payments and the transfer between office and client account. We are proposing that we keep the definition of mixed payments and say that a mixed payment can be put into either office, business account or client account, but firms have got the obligation to make sure that the money is moved to the right account promptly. So dealing away with the prescriptive rules, but making sure that the money is allocated to the right account promptly. Again, that's another issue in which we've asked a question as to whether having the ability to put the money into a business account or client account, or whether the current position where it has to go into client account and be paid out is the right one. As I said, we've drafted rules so that there is flexibility either way, but clearly very important that the money gets to its right destination promptly. But again, that would be that might be the answer to Keith's question about credit card providers, but does raise a more general issue about mixed payments and how they should be treated.
The next question is another one on the third-party managed accounts. So it says, what's the purpose of third-party managed accounts? Is it an alternative to traditional client accounts? Does this benefit PII runoff and criteria in terms of cost? So the idea behind third-party managed accounts, for example, is if you hold money in one of these accounts, it would not be classed as client money. So one of the benefits could be that you fall under the exemption criteria for requiring an accountant's report, for example. It might mean that there's less of a burden on your accounting function, depending on how the provider deals with those payments and receipts. So we hope it's just another option that you have in terms of dealing with client money. It just gives more flexibility. At the moment, it's not suitable for a lot of firms, but we hope as the market develops, it may become more of an option for more and more firms.
Just mention a question from May saying, can she download the slides that we've shown? I'm fairly sure that the slides will be available, but if not, then I'll get back to you directly, May, with a copy. Certainly, my understanding is this webinar is packaged up and available for other people should they wish to listen to it at a later date as part of our sort of general resources and engagement on the reform programme. Okay, so I've got a question here about the requirement to have a written policy in relation to interest. So the existing requirement on firms to make sure they have a written policy has been removed from the rules. It's now reflected in the draft Code of Conduct of Solicitors, which is standard 8.8. And that just says that you ensure that any publicity you are responsible for in relation to your practice is accurate and not misleading, including that relating to your charges and the circumstances in which interest is payable by or to clients. Hopefully that clears that one. It's not in the rules itself, but it is still included within the code. There's a question from Sue, probably an optimistic question. Is the removal of the 14-day rule in effect now? We know this is a thorn in many of your sides. Sadly, the answer is no. The accounts rules, as currently drafted 2011, are in force. But obviously, if I might be assuming that it's a thorn in Sue's side. It might be something that she very, very much supports. But again, be interested in your feedback on the detail of that. It looks, just looking through our question bank, that actually we've answered most of the questions. Obviously, some of the questions are coming up with a common theme around the things that we've covered. After the webinar closes, we'll take the opportunity to go through and make sure that we've captured them all, and that, as I mentioned, we're going to wrap up some of these into some FAQs, so you've got the chance to make sure that issues that you've raised have been properly covered by us in our responses. But I think that brings the matter to a close. I would just mention that there is an exit survey that I think is on your screens, and again, we would be very grateful if you could take the opportunity to complete that survey and give us some feedback on the contents of the presentation, as that will help inform how we do such things in the future. And I would just like to say, from Sean and myself, thank you very much for taking the time to listen and for all of your very helpful and relevant questions.
Thank you.